During the pandemic, home prices increased by over 43% between February 2020 and May 2022. Now, with rising interest rates and declines in home sales, this housing bubble has begun to pop. Prices in many of the hottest markets across the U.S. have dropped by almost 5% since the start of the year. Late buyers are finding themselves in homes that immediately have lost value and with mortgages underwater. So, who is to blame for the 2022 housing crash? Between March 2020 and June 2022, the pandemic housing boom coincided with a staggering 42% increase in home prices. According to researchers at the Federal Reserve Bank of San Francisco, at least 60% of that increase can be attributed to the increased demand for space during the pandemic. Along with the widespread adoption of remote work, homebuyers were able to start moving to more affordable cities during the pandemic and driving up prices for goods and services in their new communities. According to Redfin data of 21 metro areas, some of the hottest pandemic boomtowns such as Phoenix, Atlanta, Tampa, and Miami also had the highest inflation rates in the third quarter. All four had double-digit rates compared to the national average of 8.3%. This price increase added another stumbling block for locals who were priced out of the housing market by a slew of out-of-state newcomers, buying in all cash and bidding significantly more than the asking price. Of course, the demand boom isn't just fizzling out. It's doing a complete 180 with mortgage purchase applications down 41% year over year. In fact, there are fewer purchase applications now than there were at the bottom of the 2008 recession. And now home prices are rising far faster than family incomes. The home price to median income ratio is now more than 8.1, 3 points higher than the levels experienced from 1980 to 2000. The mortgage payment to income ratio reached 42% in May, the highest level since the index's inception in 2006. The mortgage payment on a median-priced home with a 20% down payment has risen from under $1,300 to more than $2,000 in the last year as interest rates and home prices have risen, which is a whopping 56% increase. And this phenomenon is nothing but a messy combination of many different culprits. Let's start with the most obvious one, the Federal Reserve. Since 2008, the Fed has kept the federal funds rate at historical lows of 2.45% or lower. Borrowing money has been cheap for 14 years, not just since the 2020 COVID drop. The Fed began quantitative easing in 2008 when it also began purchasing bad mortgages and mortgage-backed securities, MBSs, that caused the global economic meltdown, only stopping recently in September 2022. The Federal Reserve has actually purchased $1.3 trillion in mortgage-backed securities since March 2020, driving down mortgage interest rates and fueling a rise in housing costs. Now, Fannie Mae and Freddie Mac continue to dominate the mortgage market. Investors in U.S. government-sponsored security bonds and mortgage-backed securities ultimately provide funds for people to finance their homes, and these bondholders and MBS investors have implicit government backing. Currently, refinances, investor purchases, lower loan-to-value loans, and higher-priced homes purchased by higher-income earners account for roughly 90% of bond volume. Government-sponsored security bonds allow borrowers to take on larger loans, increasing housing demand and driving up home prices, putting taxpayers at risk. The Federal Reserve's current holdings of $2.72 trillion are now nearly double the levels of March 2020, artificially increasing the amount of capital available for residential home mortgages and distorting interest rates have exacerbated home unaffordability. Now, the other culprits are the investors, landlords, and short-term rentals. Investors purchased a record of 18.4% of all homes purchased in the United States in the fourth quarter of 2021. This was nearly 80,000 properties with a total value of around $50 billion, no longer available for purchase as primary homes for actual families to live in. Atlanta, Georgia, and Charlotte, North Carolina, had some of the most investor purchases, accounting for nearly 1/3 of all homes sold in the fourth quarter of 2021. And coincidentally, those areas have one of the most unaffordable housing prices as of July 2022. It's also worth noting that when filing their taxes, approximately 10.6 million Americans declared rental income, This means that approximately 7.1% of 1040 filers are landlords. The Internal Revenue Service reported this income from approximately 17.7 million properties. Mom and pop landlords, also known as individual investor landlords, own approximately 41% of the approximately 50 million rental housing units in the United States. That equates to approximately 20.5 million units managed by small-time landlords. Many rental properties, however, are not owned by individuals or families. The units are instead controlled by businesses, collectives, and other similar entities. A total of approximately 25.8% of rental units are owned by a business entity, and typically the units are in multi-family properties such as apartment buildings. And then there are short-term rentals, which we've discussed on this channel before. Landlords have managed to build many empires that they manage remotely via their smartphone apps. Social media is flooded with stories of newfound wealth from software engineers, middle managers, teachers, military personnel, and even TikTok influencers. They're buying properties out of state, often sight unseen, at previously unheard of prices. And even some long-term residents complain that these investors are changing the character of their neighborhoods and making housing much more unaffordable. According to industry executives and analysts, most of these loans are supported by regular paying tenants on long-term leases. However, in the last year, many lenders have begun to allow borrowers to qualify based on what they expect to charge per night for stays booked on sites such as Airbnb and VRBO. For the time being, real estate investors can make far more money renting out a property for hundreds of dollars per night than they can through long-term leases. And as a result, would-be property owners, some of whom are young and just starting out, can afford increasingly expensive properties. Long-term real estate observers are concerned about such transactions. According to Courtlake, an analyst with Fitch Ratings, in a bad economy, borrowers who qualified based on short-term rental income are likely to default at 3 times the rate of those with conventional mortgages. Defaults that we are now beginning to witness as a result of oversaturation in the Airbnb market and decline in travel due to inflation. In today's socioeconomic status quo, those with the consolidation of wealth and power at the top get to make all the choices for you. A normal working individual that applies to every sector of the market, especially in the housing market. Those who own the houses will always want to ensure housing prices continue to rise because your basic need for shelter is also their passive income. Now, the housing market has cooled and builders are no longer building traditional homes and are instead selling homes to investors to turn into rentals, despite the fact that they could still make a good profit. They're panicking because their homes are worth 5% less than they were last year, despite a 30% increase in value over the previous 5 years. Simply put, if there is more inventory of housing readily available and there is not enough scarcity, their housing commodity begins to lose its value. And if the house loses its value, then they would lose money. Now it costs more than half your income to own a house. People can barely make ends meet, and more than 40% of Americans don't even have emergency spending. That's it for today's video. Let us know what you think in the comments below. If you like this video, don't forget to give us a thumbs up, subscribe for more content, and hit the notification bell so that you can be updated whenever we upload new videos. We'll talk to you next time.